Now we got to look at government. What's government doing? Well, debt still remains a challenge. This is federal debt, all in red. You know, we're up $38 trillion, astounding amount of debt. The line is debt to GDP, peaked out at a little over 120 some odd percent. It's come down. Why did it come down even though we're adding debt? Because we used inflation to inflate away a lot of debt holders. And that's why we're going to continue to, what we'll continue to do, because the only way we're going to be able to manage this debt is using inflation, and that's why they're going to operate with higher levels of inflation. Deficit's still enormous, but tariff revenue is helping. Last year's deficit in 24 was 1.86. This past year, it finished in September. Government's on a September fiscal year, 1.8, so a little improvement. Debt to GDP came down to 5.9 versus 6.4 last year. But these are still unprecedented levels of deficit spending that's not in a war or during a recession. But, you know, it's going to be a big issue with the tariffs. The tariffs over the next 10 years are estimated that it could help the deficit by over $2 trillion. The problem is the Supreme Court. If they rule against it, we're going to have to give back all that money we've taken in tariff revenue, and President Trump is going to have to figure out how to pivot. So this, the Supreme Court hearing is going to be very, very profound. All right, you got to love this photo. You got to love this photo. We all know this. It's President Trump giving it to Jay Powell over the renovations of the Federal Reserve, spending $2 billion, and he's just giving it to the Fed. And he has got them under so much pressure. Why? Because he wants rates down. Why? Because he wants to accelerate economic growth, and he needs to get the interest costs on the debt down. But here's the problem. And the Fed is between a rock and a hard place of their own making. The yellow line is the Fed's targeted personal consumption expenditures. That's their preferred inflation target. I don't know why you'd want 2% inflation a year, because over 10 years that just means we're devaluing our dollar by 20%, but that's their target. But what's happened with headline CPI, Consumer Price Index? We saw the boom up during Biden, came down at the end of Biden's term, it's continued to come down, and now it's starting to hook up. Here's PCE, same thing. Now here's the Fed funds rate, what the Fed controls, short-term interest rates. So they're cutting rates as inflation's going up. They're supposed to keep inflation under 2%. So why are they cutting rates when inflation's going up? And a lot of people are asking that question. Are we going to relive the 70s, where the Fed moved too quickly to cut rates and inflation spiked again? I don't know. But remember, the Fed has two mandates, inflation, and the other one is the labor markets. And right now, you know, in 24, it made no sense why they cut rates. They did it right before an election, and a lot of people were appalled by that because there was no indication. This time around, you got a labor market that's pretty clearly weakening, so there is some justification. Every year I show you this graph. The next two graphs, I'm going to tell you, they're the most technical, but they're the biggest single reason why your stocks are where they are, why housing values, why the credit markets, why we are in the everything bubble. This is the Federal Reserve balance sheet. And up until the Great Financial Recession, the Fed's balance sheet was always consistent from its beginning. They had enough money there to manage the money flows in and out of the banking system for the economy. Because of the Great Financial Recession, they entered into something called quantitative easing. I'm going to give you a quick refresher course. I know those who have come regularly have heard this before. What is quantitative easing? It's a way for the Fed to push money into the system. They go into the banking system, into the insurance industry, into pension funds, buy treasuries off their balance sheet, put them on the Fed's balance sheet, and send back cash. That cash then gets invested and lent and moved through the system, and you increase the money supply. So they increased the money supply and increased their balance sheet. Then they tried to pull it down in 19. They were starting having problems in the financial markets. Then COVID came, and they just blew it through the roof, up to $9 trillion. And then the inflation was out of control, so they tried to stem inflation and started quantitative tightening, which is the reverse. They started selling their treasuries and mortgage backs into the market, pulling cash out. But the problem is they can never get out the amount of money they put in without cracking things and cracking the markets. And this is money supply. And that graph totally correlates with what's happened in the equity markets, why housing's overvalued, why the credit markets are in a bubble, because they pumped so much money. And you can see the straight line. We never could increase the money supply in the history of this country like we did from COVID, and it just exploded. They tried to bring it back, and now they're back up growing the money supply. What's going to determine what the Fed does, and I'm coming to my end, is AI.